Hello all. Welcome to the last video of Chapter 9. We've talked about a bunch about non-arm's length transactions and income attribution rules. I'm going to finish off the chapter talking about tax on split income. As far as the subjects in the chapter go, TOSI rules, tax on split income, is considered kind of a lower priority. So I don't want to go into the expanded examples of TOSI. I think what I'm going to do is just give you the broad details of when TOSI applies, perhaps a little bit on thinking about why it does. Um, but this video is going to be significantly smaller. I'm not going to go through everything that the PowerPoint has available for tax on split income. That said, let's get into it. Tax on split income comes from income splitting arrangement the federal government considers offensive. The two major ones are dividend sprinkling and management service structures. So what dividend sprinkling is let's say I own a business. Let's say it's a restaurant. So my restaurant earns income. Now, when I dividend out that income, it would all go into my name. I'm the business owner, I've run it. So now 100% of the income's in my name. What business owners would do is, well, why don't I just give shares to other members of the family? So instead of 100% coming to me, the dividends are 20% to me. If I have three children, 20% to each of them, and my spouse gets 20%. Now that income, instead of 100% being in my tax return, is now 20%. So all of us are in the lower tax bracket, and we're now duplicating those personal tax credits, getting to use them more times to further reduce the taxes further. Dividend sprinkling is fairly common, but new TOSI rules came in because they found that a lot of business owners were using dividend sprinkling, splitting out income that way, to help adult children who were away at school, who have no hand in the functioning of the business. So if the business is created by me and it's being run by me, why are they getting income for having no hand in it? Management service structures is also another way of it's a type of business that mostly focuses on professional services. So doctors, lawyers, accountants, they might have an incorporation that's based on professional services. So if the service is of a professional nature and the income is being generated by, say, providing medical advice, how can my child, who is not a medical professional, be earning that income in the business? How can that truly be applied? Is it reasonable that the business would be paying them income when they have no professionalism in that structure? So prior to the TOSI rules, the federal government unsuccessfully challenged income splitting in court because it used to just be considered dividends are paid to shareholders. Who cares who the shareholders are? But the CRA could see that a lot of income, a lot of tax revenue was being lost by business owners dividing up income this way. So they started with just the kiddie tax. The kiddie tax is tax for kids, and this applies to individuals under 18. So the kiddie tax applies to split income that includes taxable dividends declared and paid by private companies. TOSI rules come in for businesses that I, as a parent, own and control. Because I control it, I'm the one who decides how many dividends get paid out and to whom. That level of control is very specific. It's very applicable to the situation. If my child receives dividends from Google, okay, Google pays dividends to everyone. Um, as long as they bought the shares, that's probably not a big deal. But if I own the company, then it's very likely that I'm using these dividend arrangements to save taxes. So they focus on dividends declared by private companies or by partnerships or trusts, the beneficiaries of which are the family. So split income is included in the minor incomes child and then subtracted under Income Tax Act 20. So that income is going to be added to their income return It then gets subtracted. The reason it gets subtracted is so the general market brackets don't apply in their normal way. So it's not regular income. This is split income. The reason they subtract it is because the split income will then be added to another part of the tax return that is going to apply a 33% federal tax rate. That's the highest. So instead of having the income go through the usual steps of modifying tax brackets, the kiddie tax jumps them to the highest bracket. They do this because I might have personal reasons why I want money to be given to my children. The government wants to ensure that my reason for doing so is not for tax benefit. So they remove that potential tax benefit that says anything the children receive going to be taxed at the highest bracket. They also don't get all of the tax credits available, like the basic personal amount. They're limited to the dividend tax credit or foreign tax credit if my private company's in the US or something, and the disability tax credit. Anything they owe, the parents are jointly liable. If your children owe taxes, it's up to me to make sure that those taxes get paid because I'm their parent. So parents are jointly liable to make sure kitty tax gets paid. In March of 2011, the kiddie tax was expanded to include capital gains for those shares in non-arm's length transactions. So if I'm buying and selling my private corporation shares amongst the children and they're recognizing capital gains, those capital gains will instead be considered non-eligible dividends. So capital gains are normally 50% included, but for right now, it's going to be 100% included. That's why we have the two times. All right, so the example here is what would have been a $10,000 capital gain is deemed a $20,000 non-eligible dividend that's going to be grossed up. So a $10,000 capital gain means the full capital gain was 20,000, right? So instead of a capital gain, it's treated as a dividend. So we will report $23,000 taxed at the highest bracket. The dividend tax credit's 2,077. So our total amount owing is 5,500. If the child, under normal circumstances, had the capital gain of 10,000, that would be below the basic personal credit. The credit would cover the taxes on the capital gain, so they would owe no taxes. So we went from a situation where a child would owe no taxes to a child owes $5,500 in taxes. If I had collected this capital gain or these dividends in my name, I might have only paid $3,000. So the whole point of TOSI rules is to make tax in my children's hands unappealing. In 2018, new TOSI rules came into play. They contemplated older age groups, but their main focus was 18 to 24-year-olds. They found that business owners were using dividends to pay for children at school and to pay for their food, accommodations, etc. So instead of me giving money to my child and to pay for their things, I'm having income declared from my business to them. So that income is not taxed in my hands, it's taxed in theirs. And so they were like, well, this is problematic because they could see, because they file tax returns or they review tax returns, the CRA could see that the biggest source of dividends to the age group of 18 to 24 was from their parents' corporations. And so they were saying, well, okay, this is a lot of lost tax revenue. So we're going to put in these TOSI rules to tax this income very high. So applying the TOSI, specified individual is the individual receiving income and is a resident of Canada at the end of the year. The split income includes, I've mentioned a lot about taxable dividends, but it can be any amount that comes from a family-related business. The shareholder benefits or loans given from the private company, income from a partnership or trust that includes related business, or capital gains from those private company shares. So almost any of the any source of income or source of funds that are coming from the family's corporation. Qualified, I'm not going to go too much through the general exclusions. property acquired because of a breakdown in marriage or common law partnership. So TOSI rules do apply. I talk about children a lot. They can also apply to spouses, but if the reason the spouse has half of my shares is because it was part of like a separation agreement. We divorced, so half of our assets got split. The family business is part of our assets, so they got 50% of the shares. Okay, that's not tax on split income. That was an outcome of the breakdown of the marriage. So I'm not going to go too much into these exclusions. What I will focus on is how do I avoid TOSI? TOSI applies if it's a related business. So a related business is pretty much a private corporation or a private business that's being performed by someone who's related to me. So a related individual is a sole proprietor, partnership, corporation, trust, where the related individual is actively engaged in the business, a partnership where the related individual is a partner. So I'm getting income because someone I'm related to owns the business. But the business in which the specified individual, the person receiving the money, is actively engaged on a regular, continuous, and substantial basis. TOSI rules are trying to apply to business owners who are using tax rules to split up the income. But if your child has shares, if your child or spouse has shares in the business and are actively involved in the carrying on of that business, then it's probably reasonable that they should benefit from the profits. So if they are actively engaged in any 5 years, current and preceding, they do not need to be consecutive, then they can be considered to be active in the business. So at some point in the last 5 years, they need to have worked at least part-time, 20 hours a week during business operations. If it's a business that only needs to run 10 hours a week, then they need to work 5. They need to, in a given week, work half the time that the business is operating. So 20 hours is considered a part-time work schedule. Active engagement depends on facts and circumstances. So as long as your child is involved in the business, then we don't have to worry about TOSI rules. TOSI rules apply when I'm paying a related person out of my private corporation. But if they are active in the corporation, then that business income's excluded from TOSI rules. They're just trying to encourage be involved. If family members want to get paid, they have to be involved. Excluded shares, TOSI does not apply to individuals who reach age 25 if dividends or capital gains related to a private corporation shares meet definition of excluded shares. Does it go into excluded shares? Yes. Must not be a professional corporation. Less than 90% of gross income is from providing services. Less than 10% of the income is from a related business. So what these are saying is they found the most common corporations doing these treatments were professional corporations, corporations that provided professional services. If it's a regular corporation, a family-run business like a convenience store or a restaurant, then TOSI rules are less likely to apply. Those shares are excluded. But shares in a professional corporation, if I'm a doctor and I'm earning income and I'm paying dividends to the children, my children aren't doctors. They don't have a hand in the business. They are not professionals. How can it be that they have a right to that dividend income or at least have earned it? The other one is a reasonable return or safe harbor capital return. This is basically saying, did the child pay into the company? Maybe the child's not active in its function, but maybe the child bought the shares as a legitimate portion of the proceedings. So I have a restaurant. My child is 25 years old. They say, I think your restaurant's going to do well. I will put up some money. I'll put up $100,000. Well, when they get paid out dividends, those dividends could be a reasonable return on the money they put up. If the dividends are 8% of what they paid, then that return's reasonable in the context. They don't need to be involved in the business. They're simply earning a reasonable return on the money they've provided. Yeah, and then we talk about reasonable return. So to avoid TOSI, no related businesses. Business is an excluded business, so it's not based on professional services or service income. Um, excluded business being they are involved, excluded shares, not a professional service business. Safe harbor capital return for reasonable return on capital exceeds split income. So they've put in the money to earn the income and the amount of reasonable return based on labor, capital, contributions, and other factors. So I'm going to stop there. There's a handful more slides on the application of TOSI, but I don't want to go into it. I want to stop. But that's generally how TOSI applies. Children whose parents or some related individual owns a business, if they're going to get money, I emphasize children because it usually applies to them, but this does go for spouses. If children and spouses are going to be collecting income from a family private business, they need to be involved in it or have paid into it in order to say earned those dividend income. If they've done that, then TOSI rules likely aren't going to apply. If they do apply, their tax rate is 33%. It's immediately that highest tax bracket. If you have any questions, please feel free to send them to me. Until then, that is the end of chapter 9. When we come back, I'll see you in chapter 10. Thank you.